Welcome to the latest edition of Structured Finance Conversations. I'm Susanne Matern, head of the EMEA Structured Finance team, and today I'm joined by Eberhard Hackel, head of our EMEA ABS team, and we are going to discuss trends in the ABS market. So welcome, Eberhard. Let's start with the macroeconomic environment. We have seen quite a lot during the first half of this year. We have seen escalating trade tensions, new tariffs coming in, overall more geopolitical uncertainty. This has led to downward corrections for global growth. In Europe, we see subdued growth, but also a divergence in developments between countries. And in some markets, like in Germany, we see softening labor markets. So what does that mean for the situation of the consumer?
So overall, the macro figures don't look bad. Eurozone inflation is falling towards 2%. Rate cuts and rising incomes have helped affordability. But most importantly, unemployment in Europe is close to a record low of 6.2%. There are some regional differences. We see a north-south divide, this time the other way around, with the south of Europe doing better than the north. The Spanish labor market is very solid, while the German one shows signs of weakening. So in the light of this, our unsecured and credit card portfolios are doing very well. The defaults and losses are on a stable level. The delinquency and loss ratios are flat compared to last year. And if we look ahead, we believe that this positive trend will continue into 2026. Why is that? There's solid bank lending. Many banks have tightened their underwriting standards and reduced risk appetite. Incomes are growing, not only in nominal, but also in real terms. The wage growth is slowing now, but real wages have almost reached pre-pandemic levels. On today's data, stability is more likely than stress.
That sounds good. Do you see the same happening for auto loan and lease portfolios?
Yes, it's the same robust picture across Europe. The delinquencies and defaults have slightly increased, but we would call it more a normalization from artificially low levels that we have seen during the pandemic.
Okay, then let's move on to car prices. There have been quite some interesting trends during the pandemic. We did discuss supply chain disruptions. They have led to higher car prices. Then subsequently we have seen a correction. And on top of all of that, we have also the trend from combustion to electric vehicles. So what's the situation on the used car market at the moment?
Yeah, prices have fallen quite a bit from the highs reached during the pandemic. But here the price decline is slowing more and more. We see already a very stable trend in big auto markets like Germany and the UK. And it's important to note that we are still well above historical averages. In our ABS portfolios, we even see already rising recoveries simply due to the fact that we have more and more newer cars which have not experienced the full swing from peak to trough. Going forward, there will be more of a price correction, but we don't expect a drop the pre-pandemic levels.
Okay, that's good to hear. Now, the large area of concern with regard to used car prices is really with battery electric vehicles. The question is always, when will a viable secondary car market develop there, and what are the prospects for recovery? So what's your take on that?
Yeah, the price drop has been much more profound for electric vehicles than for traditional diesel and petrol cars. But also there, the market is gradually stabilizing. But there is price pressure from various sides, rapid technology change, the entry of Chinese manufacturers into the European market, tariff uncertainty. All this is not helping prices. So far, electric vehicles are not of a huge relevance for the rated or the ABS portfolio world. Even though in European new car registrations, alternatively filled vehicles have now reached 60%. These are predominantly hybrid cars. Electric vehicles only make up 15% of the new car registrations. And in our portfolios, the figure is even lower, on average below 10%, because these have also a share of slightly older used cars in it. So liquid secondary car markets only slowly developing. There are, of course, cars coming back from leasing. The volume is of the market is growing, but the car manufacturers try to manage supply, for instance, by giving leasing cars a second lease cycle instead of putting them up for sale. and buyers are still difficult to find, because if a buyer is concerned about buying a new electric car, it's maybe even more concerned about a change in technology if buying a used car. But now coming to the price development, we expect a further drop, and prices will be more volatile compared to traditional cars. In our rating methodology, we account for this by using higher haircuts for residual values. In leasing portfolios and loan portfolios, we have so far not differentiated. We have not big shares in the portfolios. We would only reconsider this approach once we have really meaningful shares of electric vehicles in a loan portfolio.
Well, thank you. Now, we have discussed unsecured consumer loans, credit cards, autos. So is there any subsector in your portfolio where you have performance concerns?
Yes, these are SME ABS transactions. These are equipment lease transactions with SMEs as lessees. These companies are more exposed to economic cooling and tariff uncertainty because cost shocks pass through quickly. They have limited pricing power, and planning around volatile tariffs compresses earnings. This is different to employed private households which have a more stable income stream and benefit from social security nets. So to account for this, we have revised the asset performance outlook for SME ABS to deteriorating from neutral. That means that we expect a further moderate increase in losses, but not to an extent that ratings come under pressure.
Okay. Now, last but not least, no auto ABS discussion this year without mentioning the commission problem in the UK, which also has led to the case that we didn't see any public auto ABS coming out from the UK in the first half of the year. Now, I guess the market is starting again. So what are the latest developments on this?
There's some uncertainty is gone. Not everything is solved. So the recent Supreme Court ruling has narrowed the risk of large-scale compensation payments. It did not find that banks owe a fiduciary or disinterested duty to their borrowers and that they act in their own interest. As a result, mass claims only on the basis of undisclosed commissions are unlikely to stand. Our credit view has not changed. For an auto ABS investor to take a loss, three things must happen. The originating bank is unable to compensate the borrower. The borrower has a right to set off. And the credit enhancement is insufficient to cover such losses. In practice, if you have strong sponsor banks, there are no clear-cut set of rights for borrowers, and UK auto ABS have high credit enhancement due to their VT and RV exposures. So with that regard, we see auto ABS in the UK well shielded. Our bank analysts believe that the remaining risk from redress schemes is limited and that they are largely absorbable by bank earnings and actions already taken.
Thank you for joining us today, Eberhard. And if you have any questions or would like to continue the discussion, please send us a note to the address on the screen. Thanks for watching.